Stephen Meade again, back with the Bullseye Guy podcast. Close to the end of the year. A lot has happened, obviously, in 2022 going into 2023. Let's do a quick little kind of crypto recap at the beginning of 2021. I can't even remember now because of COVID, everything's a little weird, but I believe in the last 12 months, we've had some pretty tragic things happen in the crypto industry. So, number one, crypto's down. Right. Again, what do we define crypto as? I define most crypto as a glorified penny stock. You buy it at 10 cents because you want it to go to $1, not because you're trying to buy a cup of coffee. So the word currency and the word crypto, because of the cryptography, kind of throws the whole thing off. But we've had some downs, right? We're in another down year. And people go, oh, crypto's bad. Well, again, we're going to address this crypto bad in this podcast. We're going to do sort of crypto 2.0, right? What's coming next? We could say crypto 1.0 was the ICOs and the first ones. Maybe crypto 2.0 was last year. Maybe this will be crypto 3.0. Maybe we'll do that. So this is crypto 3.0 to match up with Web 3. We're going to go with that. Crypto 3.0. The 2.0 will be this last year with the collapse. So what do I mean by that? Number one, we have the problems with Celsius, and Alex and the team and Voyager. And then obviously FTX with the recent collapse. And I got interviewed a couple of times. People, oh, crypto's bad. Saying crypto is bad because of FTX and Sam Friedman is like saying stocks are bad because of Bernie Madoff, right? Stocks aren't bad. What Bernie Madoff did was he took people's money, showed them fake account balances, and he took that money and he spent it or traded it or lost it. What did FTX do? A lot of the same. Money was deposited with FTX. That money was taken out of FTX, put into another organization called Alameda, and then it was traded. Now, what they also did that I believe was a little outside the realm, if you're an OTC, an over-the-counter penny stock in the US especially, you're regulated by what are called pump and dump schemes. You can't put out fake press releases. You can't run your stock up and sell and trade out of the back end. Crypto tokens doesn't have that same problem. I won't call it a problem, doesn't have that same regulation. So a lot of what FTX did was created their own token. Let's call it a penny stock. Manipulated that token up, traded it, market makers ran it way up, used money to run the market makers, and then when that token was high, borrowed against it. A lot of that would be illegal in the stock market. So we've got some challenges where part of what FTX did was just pure, in my opinion, fraud and manipulation. They took money and traded it and lost it. The manipulation on the FTX side for the token was a little different. It was a classic kind of pump and dump opportunity that's regulated in the US. So I hope some of the regulatory bodies eventually look at crypto more so. If you're using crypto to raise capital or to borrow against, it is an asset. It is a security. It should be treated as such. If you're trying to use a token as some sort of payment mechanism where you're putting $1 in for $1 token to buy something else like a stable coin, different function of money. I've talked a lot about that. And so I think as crypto moves along, again, I'll say one more thing. In one of my other podcasts, John Najarian, brilliant guy, friend of mine for decades. John asked me a question and said, do I think crypto will ever be bigger than the stock market? And my comment was that question's irrelevant. It doesn't make any sense because eventually there will be no more crypto. And he said, oh, do you think crypto will go away? And I said, no, it's actually the exact opposite. The stock market as we know it today won't exist in the same capacity technologically. If we look at cryptocurrency and take the currency out of it, right, all the crypto is really a digital asset. If I want to buy a stock, again, if we want to buy a big stock, a New York Stock Exchange, I can go to a broker. Now there's online platforms, right? There's TD Ameritrade and there's all kinds of platforms I can go and buy stock and I can buy and sell my own. I don't need a broker. In the old days, you kind of needed a broker. If you want a money manager, you do. To buy an over-the-counter, an OTC, a micro cap, it's a lot more difficult. In the US, there are only a couple exchanges that allow you to buy it. Institutions won't actually buy. They can't buy an OTC, a microcap, a penny stock, as it were, anything sometimes below $4 or $1, you can't buy a stock at that level. The institutions, the hedge funds, the pensions, the big money, right? Again, and what do I mean by big money? It's pretty easy. The whole crypto industry, as big as we think it is at this point about at 1.3, 1.4 trillion. PIMCO is 2.5 trillion. I think BlackRock is 7 or 8 trillion. Like the entire industry is infinitesimal in terms of the financial industry as a whole. So there's massive room for growth. But back on point, trying to buy an over the counter micro cap in the US is difficult. There are only one or two platforms you can go to buy it. In my understanding, I don't buy that often. I don't buy any actually, but I own some from prior opportunities. Beside the point again, to buy an OTC, you're limited to the velocity and the liquidity and the number of participants on the over-the-counter exchange in the US. Now you've got the ASX, the Australian Stock Exchange, TSX to Toronto. You have these different exchanges around the world, but all of that liquidity is spread about. So when I said crypto, will crypto be bigger than the stock market? The question doesn't make sense because the benefit of cryptocurrency is we look at it as a classified asset, a digital asset, or a type of stock. There are massive advantages over traditional stock market. In the early days of Bitcoin, right? We were in early trying to figure it out. Brock Pierce, the legend, was talking to us. I remember one time Brock was explaining to me about Bitcoin's like an apple where you only have one apple. And if you take a bite of like he was trying to explain it to me. This was in I think 2010, 2011, 12, somewhere in there, long time ago. Lots changed. But digital assets have a lot of advantages. If you have a traditional stock, this is what I missed in Bitcoin. When Bitcoin was super early, right? 25 cents, 50 cents, $1. To me, I looked at it like a penny stock. Get in early, double or triple your money and get out. The concept of a single asset like a Bitcoin growing to be $1,000, $5,000, $10,000 never struck me because traditional stocks, that can't happen. In stock, you had a delta, you had a certain amount of threshold of pricing where if Apple stock got, 8, 9, 10, 8, 900, $1,000, 12, 15, if it got too high, it would split. Why? Because a normal investor, like I'll call normal, a lot of times to buy Apple stock through a broker at the time, you needed $5,000 or $10,000. A stockbroker wouldn't deal with you unless you had a certain amount of money. And if Apple stock's at $1,000, you're buying 10 shares. If Apple stock's at 5,000, you're buying 2 shares. It doesn't look the same. So these stocks, traditional stocks, get to a certain price point and then they split. That means for every 1 share, you get 2 shares. And usually, whenever the stock does a split, a lot of times the company will, let's call it shenanigans, especially at the over-the-counter. They'll issue more stocks. They'll issue more shares. They'll issue golden parachutes and handcuffs, and you'll split, but then they'll issue more shares and you're diluted and your percentages are worth less. The manipulation that can go on in the traditional stock market, even though it's regulated, is still pretty high. On the over-the-counter, that's different because you still have transfer agents, right? You have even more manipulation. You have even less transparency. Why is this important? A digital asset, let's call it a cryptocurrency. Eventually, we call it a digital asset, and we're calling it out of Bermuda now a GAO, a global asset offering. That's what I'll talk about in Crypto 3.0 when I finally get to that point. A little educational side here. If you have a digital asset as a stock, if Apple moved everything to digital, not traditional. Now, granted, their stock market is digital, right? You don't really get stock certificates much anymore, but it's still a legacy system. All right. Again, the analogy I use, it's like a railroad, right? The railroads built in the 1800s were big steam locomotives built on 2 steel tracks. And even today, those steel rails still exist. And you could put the best engine in the world on those tracks, and that train still isn't going to go as fast as a magnetic levitation, a super train, a bullet train in China, a maglev. right? No friction. The magnetic levitation of a super bullet train, 220 miles an hour. Man, they're fast. I took them from Hong Kong to Shenzhen, and you don't even know you're going 200 miles an hour. They're both trains. They're both running on tracks, sort of. A steel rail track is slower than a magnetic left track, even though they're both tracks. They're both types of train. What's the importance of that? Traditional stock, even though it's digital, you get a stock certificate, on your computer, you can see your balances. It's digital, but it's still on some legacy technology rails. The new digital, totally different. So if Apple moved off of traditional rail to digital rail, if we were to call it that, all of a sudden that Apple stock, it could go from 1,000 to 2 to 5 to 10,000. Apple doesn't care about the elasticity of the share price. Why? Because in digital, you can buy in fractions. That's what was so fascinating. Especially traditional stock, you couldn't do that. Robinhood sort of moved that around where you can buy smaller. But if there were $1,000 of Apple stock, if Apple was $1,000 a share and you only had 25 or 50 or $100, you were locked out of the financial markets. You couldn't buy fractions. Digital changes all that. That's why I'm so fascinated with Bitcoin. Bitcoin's price is irrelevant. If Bitcoin's at 15,000 now, is it a good buy? It depends. If it goes from 15 to 30,000, that's a double. If you can only buy $100 of Bitcoin, not 15,000, and it doubles, your percentage is the same. Your $100, if Bitcoin goes 50 to 30,000, 15 to 30, your $100 goes from 100 to 2. The fractionalization of a digital asset makes traditional stocks not competitive long-term to digital. So that's why when I said there won't be any such thing as a cryptocurrency, they're all going to be digital assets. They're just going to have different functions. And the benefit as well with a digital asset like a cryptocurrency is liquidity across exchanges. What do I mean by that? In the US, if we want to go public on an IPO big market, like that's a whole different animal. That's long term. NASDAQ, you can do direct listings, but an over the counter OTC direct public offering, we could buy a shell, we could go listed, we could be public. But the goal of the over the counter stock is two things. One, you want to get your share price up high enough and your volume. In the OTC, if you had 5,000 people in your shareholder base and trading, that's pretty good liquidity, but your goal is to uplist to NASDAQ on the US. Why do you want to uplist? Because when you uplist, so this includes hedge funds, pension funds, not so much venture capital, but big institutional money can come in. What does that mean now? You've got bigger money, but they're also looking for less risky projects. And they might be looking to invest in something that's either growth and appreciation or potentially dividend producing, right? Pension funds and bigger companies are looking at things that are a little more solid, a little bit bigger, a little less risky, and sometimes a little more revenue generating. Now, it might be a dividend. And again, dropping it in here early, the big boondoggle that's coming, the one we're excited about, green bonds. We'll have a whole nother podcast on green bonds coming up. Again, need to stay focused, but the institutional opportunity. So with an OTC, you uplist for bigger institutional money, but you also uplist for volume. In a digital asset, a crypto exchange, you don't uplist, you outlist, meaning you've got multiple exchanges around the world. That same digital asset, if it's listed on Binance or Bittrex or Bitfinex or CoinCap, it could be listed on multiple exchanges around the world. Not only do you get that additional liquidity, you can now run marketing programs. If you want to list into Korea and you want to go OKX, you can do a program marketing specifically around that particular geographic region. You can also use platforms now. In the early days, my first over-the-counter, my first OTC penny stock, the big communication bulletin board, it was called Raging Bull. And it was this online bulletin board and people would talk about the stocks. Well, now you've got these community tools. You have something like a Telegram. And with Telegram, you can build your own community, and it could be 2 or 3,000 or 5 or 10 or 15 or 20,000 people. Again, why is that important? The liquidity on an over the counter, an OTC, is limited to the value in the liquidity pool and the members of that over the counter market. That's why you try and uplist. With digital, you can do all kinds of things. What does that mean? Crypto 3.0, in my opinion, there's going to be different projects coming out. I'll give you an example of one we tried to put together before the war, and I'll walk you through the structure of it, but it's a legitimate, and by legitimate, I don't mean a lot of the crypto projects weren't legitimate, but this was a $7 billion private company. Just follow me for a moment. If you were going to do a traditional stock listing, this is traditional stock, direct public or NASDAQ listing versus crypto 3.0. Traditional stock says we're going to do a listing. We're going to try and list on the stock market, maybe direct into NASDAQ, maybe an over the counter. Then maybe we'll dual list into the Australia because the ASX people love gold mines and things like that. Or maybe we'll go Toronto because we like the Toronto guys in the legislation there. Maybe we'll throw something out in Dubai, even though Dubai doesn't have much liquidity. Like, where would we go when we list multiple jurisdiction? Digital assets going to be different. This was a $7 billion private company, oil, gas, natural resources. So that's the market it was in. Again, 7 billion private. They were sitting on a $10 billion certified liquid natural gas, an LNG asset, right? It's in the ground, certified natural gas, geologically certified. This is traditional. And this company was going to try to raise $500 to $600 million to build a plant, to put the plant on the actual gas field to extract the liquid natural gas to produce the output. And they thought it was a 10 to 12 year field. It would produce, liquid natural gas. You'd be able to sell it. It was a profitable endeavor, just like they did normally. And this particular oil field or gas field was in Russia. So as you can imagine, here we are at the end of 2022. There's still a conflict between Russia and Ukraine. So it slowed down. But just follow me again. Crypto 3.0, what's the difference? What we were structuring was a somewhat traditional kind of, if you use a stock offering, if you did a NASDAQ level stock offering, 75 million direct listing, you're on NASDAQ, then you tried to raise $200 or $300 or $400 million in a public stock offering. But what did that stock do? That stock had a little bit of not only liquidity, but a little bit of appreciation, but it was going to be a dividend producing stock. So that stock should go up in value over the next 2, 3, 5, 10 years as the liquid natural gas, as the LNG was extracted and sold, that would produce revenue, and that revenue could produce a dividend, traditional stock dividend. But a $500 or $600 million offering is much more traditional, right? It's a liquid natural gas. It's building a plant. It's extracting gas. It's paying a dividend. It's all traditional types of stock, but we're on the old rails. Doing a NASDAQ direct listing, expensive, regulatory, limited volume to the NASDAQ, even though, the US has the biggest markets in the world by volume as a single exchange. Yes. Globally, multiple exchanges. No, you got to aggregate those things together. So crypto 3.0 is going to look like this. There's some great new regulatory issues out in the US. So Reg CF or Reg A plus. These are terms anybody in the finance industry will get it, but there's ways to raise up to $75 million in the US under a regulated, a Reg A plus. It's a traditional security offering. I believe we're going to do things as a digital asset where you'll raise up to 75 million under US securities regulation, but as a digital asset, not a stock. Then we're going to use the Bermuda infrastructure. I love Bermuda. We're going to do a whole podcast with Kevin in the group out of Bermuda. Why is Bermuda fascinating? Well, they already work with the US. They're whitelisted on the bank side, unlike Cayman, a lot of BVI guys that are kind of miscolored around the edges. But they've traditionally worked, if you're going to open a venture capital fund, a hedge fund, almost historically, you'll put it in Bermuda because Bermuda uses US regulatory authority to onboard US investors into an international corporation. So you can do an SPV, a special purpose vehicle in Bermuda, have a venture fund, raise capital with limited partners. If you look at that structure, you've got an SPV, a special purpose vehicle, raises capital, limited partners. That SPV provides distribution on the investments. I use what I call retrospective evolution. We went through this with Bermuda. We said, look, if you did a digital asset offering of 75 million, the rest was done through a GAL, global asset offering, a special purpose vehicle in Bermuda, but we did it with a digital asset, not traditional stock. So it's a cryptocurrency, but we're calling it a digital asset. Now you could raise capital up to 3, 4, 500 million globally, internationally on this digital asset. Well, what makes it different? Why isn't it a cryptocurrency? Why isn't it speculative penny stock? Why isn't it prone to manipulation like a lot of the other projects? Ah, we were going to reverse engineer it just like you would have done with a stock. You certify the LNG. So it's $10 billion certified liquid natural gas. That's the collateralized asset. Use the digital crypto asset. You collateralize it with the LNG. You raise money and build the plants. Now, the plant doesn't have a value, right? The plant's a depreciating asset. So you're not really investing in a plant, you're investing in the extraction of LNG that's going to be sold for a profit. That is the product. You tie the digital asset, right? The cryptocurrency, again, we're going to move out of that terminology. We tie that digital asset to the certification. So it's collateralized. But the smart contract, right? What makes digital digital? What makes a digital cryptocurrency a better rail system than traditional stock? Well, it's written on blockchain. The blockchain has a smart contract. What makes it smart is you can write into the contract a dividend output. All of a sudden, you can use a digital offering to raise 2, 3, 4, 500 million dollars. U.S. regulatory security compliance, Bermuda regulatory computer or security compliance. They've got the Digital Asset Innovation Act, I believe it's called. They've got crypto banking. They have the infrastructure in place and the predicated history of working with the United States to onboard traditional investors, retail investors, and institutional investors in a globally compliant and white labeled, not white label, but whitelisted model. The market for crypto 3.0, in my opinion, is going to do, again, retrospective evolution. I think traditional companies are going to look and say, wait a minute, why should we do a stock listing with full regulatory compliance, all of the paperwork, and still be limited to a US exchange? Let's do a digital offering, but let's tie in some of the same parameters and components. Right. So all of a sudden, we're going to try and do, when the markets open back up, a 4, 5, 600 million dollar raise to institution hedge funds and pensions who aren't looking at cryptocurrency. They're not looking at penny stocks. They don't want a 10-cent stock that goes to $1. They want a dividend producing asset that's legitimately backed by a project and collateralized by that company, by those assets, possibly by the LNG asset. The certified liquid natural gas asset is the collateral for the project to move forward. So what do I mean by crypto 3.0? I don't think there's still going to be early crypto projects, just like there's early OTC projects. There's over the counter penny stock projects all day long, all night long, all year long, multiple exchanges. Cryptocurrency projects will still exist. Crypto 3.0 to me, especially because of the collapse of FTX. I talked about this at the beginning. FTX has nothing to do with cryptocurrency being bad. It's a bad actor within the industry, but it gave the industry a bad mark. Just like Bernie Madoff didn't collapse the stock market, but it was a black mark on the stock market. It was a black mark on the industry, but the industry survived. I believe crypto will survive, but I really think the big opportunities are going to be in bigger structured offering, US security-based digital asset, not trying to jump through, oh, I'm a security, I'm a utility, I'm a security, but don't call me a security. Oh, we're not yet. No, we're going to full on find projects looking to raise capital, 50, 80, 100, 200, 300, $500 million, just like they do on an IPO or a traditional NASDAQ offering. Big company, traditional, historical revenue, predictability, But using a digital asset, you can do global liquidity. You've got fractionalization of the pricing. You open up a market of retail investors internationally. A guy in, again, I won't pick on Nigeria, a guy in Nigeria, a guy in Africa, a guy in India that might only have 50 or 100 or $200. That $100 to the guy in Africa means just as much, if not more, than the 100 million to the pension fund who's investing money that isn't even their money. Like the pension guys are really trying to make money. It's not their money. The $100 from the guy in Africa, that's his money. He wants something that's a good return. He wants something. Some guys want risky. They're willing to go OTC, penny stock, crypto, risk it all, high risk. But some may say, hey, I want something a little more solid. I want something a little more stable. I want something maybe that gives me an 8, 10, 12, 15% dividend. And again, the Crypto 3.0 project, we had it all mapped out. We still think we'll do these. It would have been probably an 8 or 10 or 12% guaranteed dividend, guaranteed, written into the smart contract. Not whether the company maybe does it or maybe doesn't pay it, or do they pay it quarterly, or does it change? It's written into the contract that says you get a 12% dividend on the revenue. Now, the unknown is what will the price of LNG be in the future, the liquid natural gas? Will it be higher? Will it be lower? Will it be profitable? But if you can write a dividend contract onto a digital asset and use that to raise capital, this is going to be just like traditional capital. When there's companies out there, and I won't mention them, some of them we love, some of them we want to take on these new processes. I remember getting a call a year or two ago for Klarna, I think it was, or Plaid, or one of these big companies are like, oh, Stephen, you need to invest. It's a $250,000 minimum ticket, and they're at $18 billion, and they're going to go public at 20 billion. And you know, you could get out, it's $22 a share, and you could probably sell in 18 to 24 months at $40. And the company calling me was raising $300 million for part of this company to go public. And here we are 18 months later. I don't even remember if they went public. I don't remember which one it was. The risk is there. But the point is, an investment banking group. I love these guys. If they're watching, they know who they are. They were raising capital because that's what they did. They would raise $200 or $300 million for an IPO. Why? Because it was a big project. It was value. You could project out. It opened up the institutional investors for bigger money. That's what I think Crypto 3.0 will be. I don't think it's going to be a lot of penny stocks. I don't think it's going to be a lot of crypto projects. Those will always exist. They'll always be out there. They'll always be fun and exciting and interesting. But in terms of real world, in terms of opportunity, in terms of business, crypto markets 1.5 billion. I mean, 1.5 trillion with even all of the markets, even all of the crypto projects. PIMCO's 2.5 trillion. Like the market for traditional finance is so much bigger, so much bigger. It just needs to move over. So instead of the crypto industry moving forward, I think the traditional industry will move backwards. And I don't mean going backwards in technology. I mean, I think they'll come over off of the traditional 1800 steel rails of traditional stock and move over the maglev, right? The 220 mile an hour bullet train. What's the bullet train? Digital assets. Crypto 3.0 are going to be bigger projects, digital assets, global offerings, global markets, global liquidity, and the world's going to change because of it. Stephen Meade, the Bullseye Guy, thanks so much for tuning in. I hope you all had a great 2022. We're rolling into 2023. Everybody enjoy.